Hey everybody, Chinchilla Pickin' Podcast. It is April 15th, the Ides of April 2021. We hope to make this entertaining, educational, and uplifting because we want everyone to make money. Brandon, how you doing this week, man?
I'm great. I got a new mic here, and I really appreciate everybody going through the audio torture of me talking. That was the first 5 episodes, but it's over now. I've got this new mic, thanks to Dave, which I really appreciate it. Hey, check this out. Welcome to NPR. Our next episode will be an enthralling episode on the migration patterns of ants. Hey, Dave, did you know that NPR survives off the donations of people like you?
I did. Yes, I did. Wait, don't tell me. If you listen to NPR, you'll get that. Awesome. Good stuff.
It's not our show if I don't make people cringe at least once.
That is the goal. All right, guys. Every time we go over the rules, here's the rules. Brandon and I don't talk about what we're going to talk about until about 15 or 20 minutes ahead of time. Then we meet up. We give each other our topics. We get 15, 20 minutes to discuss it. I mean, to not discuss it, but to research it, look into it, what have you. And then we go live with the show. So you get this interaction between us that is more organic than a pre-scripted show. And it's Brandon and I actually having a conversation. And this week, Brandon's going to take us off. He's got more items to cover, and I actually like what he has to cover here. I want to hear his points of view on this.
Finally, you like it.
I have a feeling we already disagree on a couple of these things, but I'm going to let you go ahead. You take the show. Roll with it, Brandon. Go.
One of the things in stocks that makes me want to smash my head into my computer the most is when somebody tells me high returns require high risk. It drives me nuts. Okay, it's almost completely wrong. There's, of course, like you can get high returns from high risk. But if risky investments were consistently profitable, we wouldn't be calling them risky. And if you were over invested into risk, overexposed to high risk, you're going to lose your ass. And if you haven't lost your ass yet, you haven't been in the market long enough. Give it time. It'll happen. I don't care if you have $50 or $500,000. If you're overexposed to high risk, it's dangerous. All right? You don't need it, especially in this kind of market. It's been pretty crazy to me for the past, actually, few years. If you have that contrarian mindset, if you have the contrarian, Dave's flashing the language sign at me right now. So, if you have the contrarian mindset and you're able to pick up on the mistakes that the market's made, for example, when the NASDAQ dropped 10% like back in March because of high bond yields, if you were able to pick up the stocks, then the high quality stocks that didn't deserve to drop, then you did well and you made a pretty good percentage, pretty good return. The fact of the matter is I've been trading like that for a long time, and the past couple of years, it's taken me like 2 months to make what used to take me like 6 months. So you can make high quality investments and get high quality returns right now. It's not too hard to do. Let's go back a couple episodes when I talked about like how it takes longer to make back the money that you lose than it took to lose it in the first place. So why expose yourself to high risk? That's speech on discipline.
Brandon, I feel people expose themselves to high risk, aka i.e. penny stocks, if you will, because they want those huge returns. They want those 80, 90% returns in 1 month type of deal, and that's what they're looking for.
But then they can get those 89%, 80 to 90% losses just as easily. And more than likely, they're going to lose money on these things. That's why they're called high risk. And even being overexposed, I watched a guy on Facebook the other day put his last $13 into Dogecoin. Everything else he had was tied up. I'm like, dude, keep some cash aside. You know? So now what are you going to do if Dogecoin drops? You can't buy it and average down now because you're fully invested already.
Yeah, I have a gentleman that I was talking to the other day that said his Uber driver was telling him to put all his money in Dogecoin because the Uber driver's cousin or uncle or somebody had made 50-80% returns in Dogecoin. And I'm just like, is this where we're at in society? It's like one guy makes 80% returns, so we're all meant to dump our money in there?
It's irritating to me too. Why is it that in most of our life we are risk adverse, except for in investments? I don't understand that. And he made the 50 to 80% return. Okay, so let's discount that 50 to 80% that guy that's now investing in Dogecoin is not going to make because it's already gone. It's already happened. So exactly. That's another thing. You should train your mind. Don't look at a stock and be like, I should invest in this because it's gone up.
Then you're chasing the dragon.
Yes.
That's what I call it.
Yes, you're chasing the dragon, and the higher that the stock's gone up, the less of a return you're going to make. Or whether it's Dogecoin or a stock or Bitcoin or whatever it is. So, that's the whole adage, buy low, sell high, right? But it's so much harder for people to do than it sounds. I want to tell a story about Sir Isaac Newton because I think it speaks to human reaction in investing and how our emotions can become involved. And it also speaks to the fact that very highly intelligent people can underperform average people if those average people just have a little bit of discipline, but those highly intelligent people don't, right? So Isaac Newton put money into a company called the South Sea Company stock in the 1720s. And it went up, and it started going crazy high, right? And so what he did is he sold it. And he started talking about how it seemed like it was too overbought. It was too high. He said that I can calculate the motions of heavenly bodies, but not the madness of the people. So he sold the stock and he made a bunch of money. Problem is not too long after that, he got caught back up in the emotion, bought the stock again for a much higher price, and then when it crashed down to the earth, he lost what would be the equivalent today of $2.72 million. So, FOMO, a 18th century version of FOMO, and one of the smartest guys that ever lived, and for the rest of his life, he forbade people from mentioning the South Sea Company in front of him ever again. So, just a little bit of discipline would have stopped, and maybe experience too, would have kept him away from that situation, stopped from reacting to FOMO, What's that, that Archeagos, is that how you pronounce it? Do you pronounce it Archeagos, that company that just lost a bunch of money?
I think it was Archeagos, yes.
Right.
I know what you're talking about.
Billions of dollars.
And, yeah. Oh, yeah. Billions. You know what's funny is this guy who ran the Archeagos was the person who taught him and mentored him also got caught running a Ponzi scam of sorts. And you would think people would have seen that coming, knowing who this guy's mentor was and what happened to him.
Yeah.
But yes, I agree with you 100%. FOMO, trying to chase the dragon there, people trying to hit home runs and turn $1,000 into $1 million in 1 year is the reason why a lot of people fail. I don't want to sit up here and be all preachy every single week in, week out, but that is a point I feel very deeply about is if you just go for your single base hits every single week in, week out, get 1% to 2% every trade, 3 trades a week, you're gonna be doing just fine.
A lot of people right now, I think, need the preachiness of it. And what I'm saying is coming from experience because I've lost I've lost money, trying to chase the dragon before. And I don't want other people to do it. But a lot of people are. A lot of people are. I see it on the Facebook friends every day, chasing highs. And, this has gone up 50%, so I'm going to put my money on it, Well, it's already gone up 50%, so like I said, that's 50% that you're not going to get. You're limiting your returns by doing it. So have yourself a contrarian mindset. You should like a stock better when it's down and like it less when it's up.
Yep.
So with that being said,
go ahead.
Let's get into banks.
Here we go.
Goldman Sachs, okay? Great earnings report. The quarterly investment revenues were $3.77 billion. That's up 73% year over year. Those investment revenues beat the almighty Jamie Dimon and JP Morgan. That's awesome. They had a massive revenue beat, okay? 12.6 billion was the expectation. 17.7 billion is what they did. That's huge. They had a massive earnings per share beat. $10.22 was the expectation. $18.60 was the reality. Earnings per share were up 498% year over year. Now the stock is up about 98.41% for the year, 11.35% for the quarter. And so I'm going to tell you, despite this amazing quarter, I think you need to start selling.
Why do you say that?
Okay, so not
that I don't disagree with you, because I do agree with you. Now, I do also want to say on this show a few seasons. This is season 3, episode 8. No, this is a few episodes back. We talked about how I was big on the banks, and if you're in my personal circle of friends, I've been saying that the banks were going to have great numbers and great trading numbers. Now, having said that, I do agree with you that, now we should be looking to take our profits off the table and exit our positions.
You're right.
But I want to hear why you think it before I say my piece.
Head over to CNBC.com and look at the Treasury. Look at the 10-year yield. Okay? 1.553%. That's where we're at right now. That's not being paid attention to the market right now. It surprises me that it's not, but we have bank earnings happening right now, so that's pumping the stocks of the banks. But I think after the bank earnings are over, the story is going to be the Treasury yield, and that does not bode well for banks. And the Fed just committed to buying a ton more Treasuries throughout the next year. That does not bode well for banks. That will come into focus. And here's the thing. Okay, so I'm not telling you just to sell these and leave them in the dust. What I want you to do is to take your profits now and then wait for a better deal. And then once it happens, and you're looking at banks with high trading revenues, because we're still going to be dealing with that all year with a lot of retail investors and stuff like that. But as I mentioned a couple episodes ago, just start looking for a bank that has a very small amount of short-term debt. That way, in case the 10-year yield does jump and the 30-year yield doesn't reciprocate it, the bank won't be in trouble. But your Goldman Sachs, your JP Morgans, and your banks that have healthy balance sheets, those are the ones that you're going to want to go in and buy. I think you're probably going to get a good deal on banks here in the next month or two, and be ready for it.
All right, so here I'm going to interrupt you here because you just said a lot of information, and I want to talk about a few certain things. First thing, and I want a little back and forth on this one too. You talked about the Federal Reserve and the yield and the relation between those two, right? I want to talk to the everyday person here, and I don't want to talk at a Harvard level 12-syllable word. I want a 1-syllable word conversation explaining. So what Brandon is talking about, guys, is the Fed is committed to buying bonds, right? So the U.S. releases bonds we bought to raise capital for the United States government to pay its bills. Well, the Federal Reserve is printing money to go ahead and buy those bonds. So the U.S. government's funding itself. Is printing money to go buy those bonds. And when people talk about the Federal Reserve balance sheet, they're talking most of the time when they mention it, they're talking about how much bonds the Federal Reserve actually owns itself. So when they say the Federal Reserve bond balance sheet is getting high and they've agreed to buy more, that's not always a good thing. Like we don't really want to be printing money in order to fund our government. We want other people to buy our bonds.
And it fuels stock market rallies, which are great, except for the fact that they often end in euphoria, and euphoria does not end well. So
exactly.
You start having this situation right now. For example, people used to go into bonds for safety and to protect themselves against inflation. But with the Federal Reserve buying up all these bonds, there is no protection with bonds as far as inflation goes. Right now, we're nearing 2% inflation. We get a 1.55% yield on the 10-year. That means that if you buy the 10-year and hold it for 10 years, you're losing money.
Yes.
It doesn't make any sense to do it.
It makes no sense to buy a bond right now. Bonds are dead, right, Brandon?
Bonds are dead. Bonds are dead.
And that goes into banks.
They shouldn't
guys,
be.
So as far as you guys want to make money, and that's the purpose of the show here. So when we're talking about taking your profits, exit positions on your banks, the banks had a good run last year in regard and in the first quarter of this year in regards to their investment returns, right? 2020 was a great year for investing. JP Morgan's of the like, Goldman Sachs all made tons of money on their investments because you saw the stock market rally. They made tons more than they ever lost in March. And in the first quarter of this year, they did the same thing because we had another quick uptick there. So they're reporting good numbers. And what Brandon and I are talking about is you don't want to look at a bank and say, okay, they had great numbers. Let me buy Goldman Sachs because it's going to go up. Well, guess what? Those kind of returns, they can't continue. So those investment returns, now the banking is divided into different sections. What we're talking about is the money these banks make off trading, stock trading, investing. They're not going to be as high next quarter. So that means they're not going to have these great earnings numbers. The banks know that themselves. Other people in all these companies like BlackRock, KKR, they know that. So they're going to exit some of the position, take some of the profit off, lower their hit to that. And so what we're saying here is, hey, you made some money off the banks. Great. Exit your positions, take your profit, wait for it to dip back down before you enter back in. And when you enter back in, you want to look at a bank that is making a lot more money, not off just investment returns right now in this environment.
Right. Well, I mean, I like that. I love the fact that Goldman Sachs beat JP Morgan on that. This is one of the most incredible quarters I think I've seen in financials in a long time. So if it comes down to it, and if I'm correct, and the 10-year treasury starts to take the spotlight, and maybe even at some point we do have a flattening yield curve, then you will get a better deal on banks. Goldman Sachs will be one of them that I'm looking to buy. Just not right now and not at these levels.
Right, exactly. I mean, yeah, it's a little too pricey. It's right. It's priced right, which means I don't see much up, moving up. It's priced right where it needs to be priced.
You really want to be looking at stocks that are below what their subjective, I guess you could say, intrinsic value is, what you would perceive the intrinsic value to be, because then you're going to buy it, and of course there's going to be a reversion to the mean. It'll come right back up. That's your goal at least.
Right, there you go. So in other words, guys, sell the banks, wait for a downtick, then go ahead and look for banks with a strong balance sheet.
And then if I'm wrong, then you've missed on an opportunity cost, but at least you didn't lose money.
Exactly.
So, all right. So, and then moving on, big news was that Microsoft bought out Nuance. The deal is slated to close at the end of this year, where Microsoft will pay $56 a share so long as Nuance shareholders approve the deal. This is the kind of deal that I love, okay? So right now we're pricing Nuance about $53. That's where the market kind of wants to keep it. It's around a 5 to 5.5% difference between the share price that it's at right now and where Microsoft wants to buy it. So the market's kind of keeping a little bit of a margin of safety there, just in case, things go awry. And I think there's maybe a little bit of a risk of regulators getting involved and saying that, maybe this deal would be a problem and that Microsoft would have maybe some privacy issues with customers in the healthcare field. But I don't think that's going to be that big of a deal. I definitely don't think that this is a monopoly issue. So I see a very, very small chance of regulators getting involved in stopping this deal. Little bit larger than that would be the chance or the possibility that Nuance shareholders will maybe reject it, but I think they'd be crazy to do so. So, this is only 5% if you get in right now. So what I would do, just keep this on your watch list, okay? I've bought in already. I bought in a couple days.
Only 5%? I love 5%.
But it doesn't go to that 5% a week thing, so you're going to have to wait till the end of the year, right? But, it's guaranteed. Okay, I shouldn't say guaranteed money because something could happen. Something crazy could happen and stop this deal from going through. I don't think it's going to. I think this is as close to guaranteed as you can get. So I say put some money into it. And hey, if you see this and some short-sighted traders sell this thing off and it drops to 52, 51, put even more money into it and just keep watching the news and make sure that if the drops happen, that the drops aren't happening on bad news, and just wait it out, because I think there's nothing better than having peace of mind. And if you can see that you're going to make 5% and you're 99% sure, why not?
Right? I'll take that any day of the week.
Warren Buffett used to do it. So Warren Buffett, what he used to do every morning is he would monitor the news for mergers and acquisitions, and he would go in on things like this that looked like they were for sure. So if you're for sure, why not do it? And one of my favorite things about this deal is not tethered to Microsoft stock. So it doesn't make a difference whether Microsoft stock goes up or down. Kind of like that Sprint, I think it was Sprint and T-Mobile that happened a couple years ago, was that right? And Sprint's stock was tethered to T-Mobile, so, and you would have that volatility. But this is just straight up $56 a share. No ifs, ands, or buts. I love that.
Straight all cash deal, right? You and every realtor, all cash.
Yep, exactly. And so, listen, I talk a lot about CNBC and I criticize them a lot, so I want to give them credit where credit is due. After the whole Alibaba thing happened, when China, just a couple days ago, I think it was Monday, came out, and we figured out that what they're going to do is they're going to fine Alibaba $2.8 billion. So we knew for the past couple of months that the Chinese Regulatory Committee, an anti-monopoly committee, whatever they're called, was looking at Alibaba, and the rumor was that it was going to be a very big fine. We just didn't know how much it was going to be. And we didn't know what the repercussions of them looking into Alibaba was going to be either. So CNBC, what they did is they waited until we found out what the fine was, which was $2.8 billion, roughly about only 4% of the company's domestic sales. Then they said to buy it, okay? By this point, Alibaba's stock was already up 6%. But prior to that, there was so much uncertainty, I wouldn't have touched it with a 6-foot pole. Now I'm saying I think they're right. They were right to wait this one out. I don't...
Now, hold up. I'm still hesitant, and it's because of the Chinese government. They're looking into the investment financial firm of Alibaba that they want to split up and break apart and take that away from those profits.
Nope. That's not a thing. It might be in the future, But it is very stated, it was very clearly,
Very stated.
very clear here that Alibaba is not going to have to make any divestitures. So this is basically like back to business as normal. Except for that you're dealing with a communist government and they're kind of unpredictable. So that's your risk here, right? Like, I mean, we had a situation where the co-founder of Alibaba, Jack Ma, he stepped down as the executive chairman back in 2019, but this is just, it's a good example of what you're dealing with the Chinese Communist Party. I mean, he criticized regulators and then went missing for like 3 months. And we've seen him now golfing, I think, like a month ago. So we know that like he's at least healthy. But there's still that rumor that could very well be true that he was in prison for 3 months secretly.
You don't know. I don't know. I don't want to put the gossip and rumors out there. I'd rather stick to the facts. What can we trade? You're calling Alibaba a buy, from what I can tell. Is that true? I'm calling it a buy, but I do want people to look at, like, you know, this was an issue for Jack Ma. Like, this was a whole part of the narrative here. For 3 months that he was gone, and now we know he's good, which is good. But we did know that a big fine was coming, so I think it was fine to wait that out, in my opinion, and buy it now. I like it. Listen, highlights of this thing. They have 45% gross profit margin. Return on equity is 19.78%. So Alibaba's cloud sales grew 50% to $2.5 billion. And I like it. I say buy it. And I mean, we're down like almost 30% from its all-time highs. So yeah, and it's gonna, just like Amazon did here. It has the same setup as Amazon, but in Asia. And so it's gonna grow just like Amazon did, as long as the government where it's based doesn't step in and break things up. So yeah, it's a good long-term buy and hold. I see good returns on it in the long term for that. But especially in that respect, I mean, you got to look at Coupang out of Korea, CP&G, and just take a look at that one as well. If you're going to be looking at these Amazon-like companies in other areas of the world, you know, I mean, that's the same thing.
Yeah, Jumia, I think, is for Africa.
Yeah,
JMIA. I will say this: Amazon is looking at opening up in Korea, so that could be a big problem for Coupang. Yeah, and I know some people that lived there recently and say that company Coupang has actually gone downhill a little bit.
Gotcha. Cool. All right, man. What else you got for us?
That's all I have. I want people to stay disciplined, and I have to tell you, better than any stock that you can invest in is investing in knowledge, especially at the very beginning. Go read books, read Benjamin Graham, all right? Read Warren Buffett's stuff. I mean, read the shareholder letters and books on Warren Buffett, and, you know, find what's right for you. But if you're going to put $30 into Dogecoin, you should be fine with spending $30 on 3 books. Right?
Yeah, I like that.
And I have a lot, by the way, I have a lot to say. You're going to talk about, one of the things you're going to talk about is going to be cryptocurrencies. I have a lot to say on that too, so.
Well, hey, since you started that, let's just go to that one first. Cryptocurrencies and Bitcoin, that's been my thing. Last week I touched a little bit on that there and covered some of my thoughts and how I wanted to trade it. I even posted an article to the website on Riot and how I thought you should view that, how I got into looking at it as a channel and what things I looked at when I looked into channeling that stock. So one of the things I want to talk about was the Coinbase IPO. And I want to start off by saying what my thought is on it and where I see it going. My thought is it's a buy, and I see this going higher. And my reasoning for that, now I'll get into the reason. Now that I got your attention with, David said it's buy, David said it's going higher. Now let me tell you all about why. Here's why. In the next few years, you can still get coins for mining Bitcoin. So the miners are still going to be out there. There's still going to be people investing in this. There's still going to be these Bitcoin ETFs. There's still going to be Bitcoin moving up higher and higher and higher. So as Bitcoin moves up higher, as more people start using Bitcoin for purchases at different events, different companies, different online stores, what have you, it's going to go up in value. And the more people are going to use it, people are going to trade it. Where are people going to trade it? The most commonly known one is Coinbase. People are going to go to Coinbase. They're going to use it. It's going to go up in value. I see Coinbase going up pretty high. I'm willing to invest in it right now at its current levels and hold it. Now, I will say, and I will specify this and disclose this for the 3 trusts that I manage for kids, 1 for my kid and 2 for friends, kids. I did invest in Coinbase. I put a lot of their trust funds in Coinbase. And so I believe in it that much that I'm putting their future in it. It's going to go higher. Go ahead, Brandon.
Here's my concern, okay? We know that the Federal Reserve pumps asset bubbles. And what they do when they kill the bonds is they're forcing other people to take risks, right, that they wouldn't normally take. And then what happens when those institutions, instead of going into bonds, what they're doing right now, I think, is they're buying Bitcoin, and I think they're buying maybe even Dogecoin, but definitely Ethereum and Litecoin and stuff like that. So they're pumping a lot of money into that. And then the retail investors see that, and then they jump on top of it. And then, so I am honestly worried that we're in a crypto bubble. And I'm honestly worried, too, that Coinbase may be a symptom of that.
Now, Coinbase doesn't make its money off of Bitcoin moving up in value. It makes money off of that, but it makes its money off transactional fees.
So then my worry about that is if Bitcoin does drop, if this is a bubble and it does pop, and we go into a bear market with crypto, and of course this is all like I
disagree. We're going to go into a bear market with crypto. Because I believe, Brandon, more people are using this everywhere we go. The NFTs, online NFTs, every star you could think of, you could throw a rock and a famous celebrity who's coming out saying, "I want to get paid in Bitcoin nowadays." It's gonna be it's moving towards the way that people want to get paid. They want to get paid in Bitcoin. They want to use Bitcoin to pay. It's being requested, dude. This is not going to go away and be a bear market. It's not in the stock on investment.
It might not go away. I mean, the internet's still here, but we went through the dot-com bubble of 2000. You know what I mean? So it's still, the internet is, of course, still of value. But, like, Yahoo was trading at like $100 billion and then sold for like a fraction of that just a couple years ago. So, I mean, I'm not saying that's what's going to happen. I'm just saying it is a concern. Like, if you connect the dots with the Federal Reserve pumping all of the money that they've done into treasuries and contributing to inflation, and now we have inflation fears. One of the things that may prove that Bitcoin is not a bubble is if we have the dollar devalued throughout the year to a point where it makes sense that people are jumping into crypto. At that point, maybe crypto and gold, maybe their market caps meet somewhere in the middle. But and then you can look at it as a store of value and against, so I mean I could be wrong.
Are you really looking at Bitcoin as an actual currency, or are you looking at it right now as a stock?
I'm looking at it.
I feel like you're viewing it as like a stock or maybe even a commodity of sorts, and not as a currency that people are wanting and requesting to be available to use at different places.
That's possible. Yeah, I mean, maybe I am. And part of my problem with Bitcoin, I've owned it in the past. I've bought it and sold it. But part of my problem is it's fairly hard to value. Now, Doji is a lot more hard to value than Bitcoin because Bitcoin is at least finite, like you're eventually going to run out. Like there's a certain amount of Bitcoins that you have. Doji isn't. but it's hard for me to value, so it's hard for me to see where it's going to go. I wouldn't be surprised if it gets to 100,000 by the end of the year. But I also,
and then if Bitcoin hits $100,000, I value Coinbase at $1,000 a share.
So right now, crypto is, the market cap is, I think, 600 billion, and Coinbase is 100 billion. So it's 1/6 of the total market cap of crypto. You tell me, because I'm honestly, like, I don't know. Is Coinbase big enough to justify being 1/6 of all of crypto? Is it that big? I mean, people use Kraken and Robinhood too.
I'm going to say yes, because if you look at, here's the thing, and here's where we're disagreeing is, if you look at Facebook, if you look at Amazon, and if you look at these FANG stocks, if you will, are they based off the current value today, or are they based off of future growth 2 to 3 years down the road, based off their PE and their value, what it would be 3 years from now?
Well, forward, yeah.
It's future. It's based off their growth, right?
Right.
And so if you're looking at Facebook and its value right now is based off its growth 2 to 3 years down the road, and this is a technology stock at Coinbase, I mean, you got to value it the same. But the question then goes is it a technology stock? You know, I value it the same way. I'm valuing it as a growth stock 2 to 3 years down the road. I see more people getting into Bitcoin. They need some place that will give them a wallet so that they can use this to pay at different places. And they get this in place that they can use to make transactions and move it into US dollars and or other cryptocurrencies. And Coinbase is where everybody's going to go.
So to be clear, I'm not saying that it is a bubble. I'm saying that I'm concerned that it might be a bubble. Do you see kind of like the difference there? Like the risk for me, like, in my opinion, maybe a 20 to 25% chance that this could be a bubble. It seems rather euphoric.
I think you're being a little too cautious, and it's just because you don't have a Bitcoin wallet and you're not using it to make purchases. And I believe if you take $100, you put it in Bitcoin, in a Bitcoin wallet, and you actually go out and purchase things with it, do a small purchase with it, you'll be like, okay, I see what we can do with this.
Well, we went through this, like, not me and you in particular, but like, so as a society, like 3 years ago when Bitcoin was at 20,000, and I remember saying on Facebook, this is a bubble, people be careful. And then everybody saying, well, Bitcoin's going to be around for a long time. And I'm saying, well, it's not, I'm not saying that it's not going to be around. I'm just saying it was a bubble. And then it dropped and went down as low as to $3,000.
So it goes back to our definition of how we define bubble, man, because you're defining bubble as it's overpriced and you should sell, get out, and it's going to drop. Just like you would do, we talked about the banks earlier. That's what you're talking about. Yes. You're not talking about it's a bubble that's going to pop and disappear. Because when you talk about the dot-com bubble, a lot of those companies are no longer in existence.
Right. But I was just comparing it.
Bubble, things are going to disappear when it pops. You're not talking about bubble. You're talking about it's gone up too much, and you expect a pullback or correction.
Exactly. And more like, instead of comparing Bitcoin to like pets.com, I'm comparing Bitcoin to the internet, which is like still here and very widely, useful and huge for our economy. So,
I miss those names of the .com bubble. If you're listening and you weren't around at that time, it was like car.com, pet.com, dog.com. It was very simple .coms that blew up and were worth tons of millions of dollars. And no, they didn't really have any value.
I think weren't there internet real estate people that were like buying up these domain names. They still exist, by the way. You can still do this. You can still buy a domain name just to resell it to somebody else.
Yes, I know. I had to pay for chinchilla picking. I don't know where we're at our time, guys. So I'm going to actually skip.
Nah, don't skip it. Let's keep going. This is fun.
I will briefly touch on the next topic briefly. And what I want to talk about was the semiconductor shortage and what kind of plays we could get out of it. I want to give you some stats real quick. Apple, they were spending $58 billion annually just on semiconductors and chips. Ford, their profits could be hit by up to $2.5 billion this year due to chip shortages. They even had to cancel shifts at car plants because they did not have enough chips to build the cars. Samsung sells 56 billion of semiconductors to others and consumes 36 billion of them themselves. You know, they're having chip issues as well. They're delaying launches of phones because of their chip issues as well. Here's one of the problems. Manufacturers are placing chip orders with every single factory that can produce chips right now because they don't know who's going to give them first. So they're over ordering. So everybody's getting bombarded with tons of supply. Everybody's saying it's going to take forever to work through these orders. We're going to have a 2-year chip shortage, right? Chip shortage. I keep saying that wrong. Chip shortage. Here's something that the Biden administration has pushed forward. I don't like getting political. I want to talk about stocks and business, but this has to do with stocks and business. I want to talk about how to make money. So how can we relate this to making money? One thing that was put forward was that the current administration wants to allocate $50 billion to the semiconductor industry now, they say it's to provide manufacturing plants here in the United States so we don't have to rely on overseas industries and manufacturing, but it does not specifically say that in the money or in the wording. When you look into it, it does not require that that's what they spend the money on, and that's what I have issue with that. So we can't rely on that, because if you give a business money and say, well, I prefer if you use it for this, you just gave them the money. They're going to use it for whatever they want to use it for. You didn't require that as part of the requirement of receiving that funds. But having said that, that's the current situation we're in. So we can't get enough Xbox consoles in, PlayStation consoles in, Nintendo Switch consoles in. You can't get enough phones. Samsung's delaying their launches of their phones. Apple is too. How are we going to play this, Brandon? Where do you play on this? All the semiconductors minus, I believe AMD was, not AMD, Micron was the only one not positive today. They've all gone up. NVIDIA keeps going up. NVIDIA is a rocket ship. That's a company that's just taken over. They might hit $1,000 by the end of the year. However, what do you see a play on semiconductors?
So I like NVIDIA because I think that they have the I personally believe that they have the flexibility to raise their prices. I don't know that the other chip makers do. So what's causing the shortage? It's raw materials, right? Is that what it is?
Yes.
I mean, so if the raw materials start to go up in price, but then these other chip makers can't raise their price as a result, then they're going to get hurt. But I think NVIDIA's got such a superior product that they're going to be able to do so. And I think that customers will pay it and gladly pay it just to get their chip. I don't know. My question here for you is Apple, and specifically for them, they're making their own chips now, from what I've seen and read and all of that. So
the articles I was reading the past 2 days, Brandon, and these are articles from different sources, multiple sources, saying Apple is still the number one private company of buying chips, semiconductors from all these other semiconductor producers in the world. Samsung is second. Samsung's second. So those two companies alone are buying the most of these chips, and they can't get enough in to make their products. So Apple's not quite making their own, man.
Do you think it's going to make them delay the iPad or the iPhone?
Yes, it's delaying everything. If they delayed the launch of the iPhone 12 longer than they wanted to because they didn't have enough chips. That's where it all started. And now we're seeing the ripple effects of all these shortages.
We've got an April 20th event for Apple, so it'll be interesting to see what they put out. But I've heard the rumor that the next phone may be delayed as well, and maybe even the iPad.
So, I mean, here's my question then. Like, all right, so the semiconductor companies that are going to easily have enough sales going forward because there's so much demand. They're always going to make their profits. They're probably going to beat on their earnings just because they have lots of customers begging for their product, right?
It's traditionally a highly competitive business, but there's a couple that stand out above all of the competition.
Yeah, and you and me both, we love NVIDIA. I mean, NVIDIA's our darling here. We always call that one. Now, what do you do? Like, are you worried about Apple and Samsung? Do you say, hey, maybe you should start, selling that? Should you start worrying about them getting their products out?
Well, currently I am up about 9.87% on Apple. So I'm already thinking about selling it only because of that. And, it's not that far away from its all-time high. It's like 5 or 6%. So I think it is probably a good idea to take your profits on Apple right now, just in case. I mean, I know that everybody always says you buy and hold Apple. You don't trade it, right? But if you've got that 10%, why not take it? I don't know that I'd be concerned with the chip situation for them. They've got enough of power as being the largest company in the world to be able to get around that, I think. And if you do get weakness in Apple, so if you sell it now and you get weakness in Apple because of the chip shortage, which clearly I don't think is priced into the stock right now. I don't think it is. It's still going up. It just looks to me like nobody is paying attention to that in regards to Apple. So if you sell it, then you get weakness because of this chip situation. Then you buy it because they're going to survive it in the long term,
Yeah,
but,
they all will.
Yeah, but
not all of them. But semiconductors won't. So you know who I think is the big winner in this whole chip shortage thing?
Who's that?
This goes into my last point, which should only take 1 to 2 minutes to cover. You ready? VR. I'm a big fan of VR, right?
Oh, yeah.
So here's why they are the big winners in all this. You can't find PlayStation, can't find an Xbox, you can't find Nintendo Switch anywhere. But guess what? You can find plenty of Oculus Quest 2. So you know what has outsold them the past 2 months? Has been the #1 selling console in the United States. The Oculus Quest 2. VR is here. #1, people.
I need to get one.
Beat out the big boys.
Hey, can you play that? Can you play the VR right now online with other people? Is that a thing?
Yes, you can.
That's awesome.
And here's the thing to look forward to. Oculus is coming out with a live streaming event, first one ever, and it's because all this money's funneling into VR and VR gaming. Remember, I covered this last time about the new games coming out, and they're starting to make tens of millions of dollars in revenue on all these games coming out. It was all starting to snowball effect. Now they're having a big event for new games coming out, and it's coming up in the next couple weeks. You could go watch it, see the new VR games that are going to be released. More money's flowing in. That means better games. It means more interactivity. It means better consoles going forward. VR is the way to go, guys. This is the future. It's no longer Xbox and PlayStation unless they get on board. PlayStation has a VR set. Xbox does not.
So what do you think? Like, okay, going back to the chip shortage for a minute, because this is on my mind now. Now you've got a diving 10-year treasury rate. Okay, the support was at 1.6. It broke it. It's now down below that, right? So is the narrative going to be about the 10-year treasury, or is it going to be about the chip shortage? And which one deserves more of a... Okay. It's
chip
not
shortage.
being...
Right now it's chip shortage. That's all I hear. Anytime I watch the stock news, CNBC, Bloomberg, Cheddar, Fox Business, what have you, it's the chip shortage when it comes to tech, man.
And clearly, I don't think investors are pricing it in, because look how fast NASDAQ...
It's not priced in at all. It's going to be priced in. There's going to be some kind of movement because it's going to be sustained. Eventually, they have to count it in somewhere in the price.
When you're buying and selling stocks, that's the thing that you need to be looking at. Like, what are other people not thinking, right? So if you get news like this that is seemingly pretty big, but stocks are still going up in the NASDAQ, for example, then obviously it's not being priced in. Yeah. I think you always need to think about that. And then this is why I always tell people to read books and develop the skills and look at balance sheets and income statements and all that good stuff, because other investors aren't doing that, and those other investors are your competition. So you should be doing what they're not. Gives you an edge.
Exactly. When the major automakers are canceling shifts at auto plants because they don't have chips, That you guys have to look at that and think about that.
What's it going to
That's
do?
going to affect. So when they report their numbers next quarter, it's going to look at the total amount of vehicles moved out, right? Sold, moved on, and it's going to be lower than expected. So they're not going to hit their numbers on earnings. They're going to have bad earnings. You sell now, you wait for the numbers to come out, then you buy because they're going to readjust according to the new chip availability. Anyways,
you might get
I don't want to take up any more people's time.
You might get a good deal on Tesla. You might get a good deal on Tesla. That's the last thing I'm going to say.
Yeah. Yes. All right. We've taken up enough of you guys' time. We appreciate you giving us your ear. As always, we want to be entertaining, educational, and uplifting because we want everyone to make money. Brandon, last word.
Stay disciplined, and if you're not disciplined, get there because you're not doing yourself any favors.
Have a good night, guys.